Good morning, I'm Astrid and friends. So we're from group 3 who consists of Evelyn, Nikita, and my name is Danisha. We're gonna discuss about business combination PSAK 22. So here's our table of content. First one is introduction. Second one is acquisition method. Third one is measurement principles. Next is counting and measurement to initial recognition. Next is disclosure, and last but not least is consideration transfer. First one is the objective of PSAK 22. So the PSAK 22 aims to enhance the relevance, reliability, and comparability of the information that reporting entities profit in their financial statement about business combination and their effects. So, they recognize and measure its financial statement, the identifiable assets acquired, liability assumed, and non-controlling interests of the acquired. Next is recognize and measure the goodwill acquired from a business combination or a gain on a bargain purchase and from the trustee. Next is regulate the information disclosed that enables users of the financial statement to evaluate the nature and financial impact of the business combination. Next is the scope of PSAK 22. So, PSAK 22 applies to transactions or other events that meet the definition of business combination, but they doesn't apply to formation of joint venture, acquisition of asset or groups of assets that do not constitute a business. Next, the last but not least is combination of entities of or business under common control. Next is business combination identification. So an entity should determine whether a transaction or other event is a business combination by applying the definition in the standard. That requires that the assets acquired and the liability assumed be a business. If the asset acquired are not a business, the reporting entity shall account for the transaction or other event as an asset acquisition. So a business combination is a transaction or other event in which an acquirer obtains control of one or more business through merger or merger of equals. Next is acquisition method. So application of the acquisition method requires, first one is identification of the acquirer. Second one is determination of the acquisition date. The third one is recognition and measurement of identifiable asset acquired, liabilities assumed, and non-controlling interest in the acquirer. And last but not least is recognition and measurement of goodwill or gain on a bargain purchase. Next is the how to determine the acquisition date. So the acquirer identifies the acquisition date, which is the date the acquirer obtains control of the acquirer. So the date the acquirer legally transfer the consideration, acquire the assets, and assumes the liabilities of the acquirer, which is the closing date. And then they can occur before or after the closing date. And then we must consider all facts and the circumstance. Next is measurement principle. So the acquirer measure the identifiable assets acquired and liabilities assumed at fair value of the acquisition data. Then for each business combination, the acquirer measures that non-controlling interest in the acquirer either at fair value or at the non-controlling interest proportionate ownership of the acquirer's identifiable net asset. Last is we can measure the fair value of certain identifiable assets and non-controlling interest in the acquirer.
So next we move on to the exception to recognition and also measurement principles. The first one is the income taxes, and the second one is the employee benefits. So the acquirer recognizes and measures different tax assets or liabilities from acquired assets and assume liabilities in a business combination. And PSAK 22 also states that the acquirer accounts for the potential tax effects of temporary differences and also the unused tax loss carry forwards of the acquiree that exist at the acquisition date or arise as a result of the acquisition. As for the employee benefits, PSAK 22 states that the acquirer recognizes and measures liabilities or assets, if any, related to employee benefit arrangement of the acquirer. The third one is the indemnification assets. So in a business combination, the seller may contractually indemnify the acquirer for the outcomes of a contingency or uncertainty related to all or part of the certain assets or liabilities. For example, the seller might indemnify the acquirer for losses exceeding a certain amount related to specific contingencies. In other words, the seller guarantees that the acquirer's liability will not exceed a specified amount. So there's also the exceptions to the measurement principle. The first one is the measurement of the reacquired rights, and the second one is the share-based payment transactions. And last but not least, there's assets held for sale. So for the measurement of reacquired rights, the acquirer measures reacquired rights recognized as intangible assets based on the remaining contractual term of the related contract without considering whether market participants would factor in the possibility of renewing the agreement when measuring the fair value. As for the share-based payment transactions, PSAK 22 states that the acquirer measures liability or equity instrument related to share-based payment transactions of the acquiree or replacement for share-based payment transactions of the acquiree with share-based payment transactions. And for the asset held for sale, the acquirer measures non-current assets or the disposal groups acquired and classified as held for sale at fair value less cost to sell. So there's also recognizing and also measuring goodwill or gain from a bargain purchase and the PSAK 22. So the acquirer shall recognize goodwill as of the acquisition date measured as the excess of A over B below. So the first one is A, which comprises of the aggregate of the first one is the consideration transferred measured in accordance with this statement, which generally requires fair value at the acquisition date. And the second one is the amount of any non-controlling interest in the acquiree measured in accordance with this statement. And the third one is for business combination achieved in stages, the fair value of the acquirer's previously held equity interest in the acquiree at the acquisition date. And the big one is the net amount of the identifiable assets acquired and liabilities assumed at the acquisition date measured in accordance with this statement. There's also an additional guidance, particular for types of business combinations. So for business combination achieved in stages, the acquirer remeasures its previously held equity interest at its acquisition date fair value and recognizes the related gain or the loss in profit or loss. And for the business combination achieved without the transfer of consideration, the acquirer gains control of the acquiree without transferring consideration. So these circumstances include the first one is the acquirer purchasing its own shares in an amount sufficient for the current investor or the acquirer to obtain control, or it can be like the loss of minority veto rights, which previously prevented the acquirer from controlling the acquiree, where the acquirer has majority voting rights. So there's also the measurement period. So for the business combination, there are several measurement periods that we have to consider. The first one is the identifiable assets acquired, liabilities assumed, and any non-controlling interest in the acquiree. The second period is that the consideration transferred for the acquiree or other amounts used to measure goodwill. And the third one is in business combination achieved in stages, the equity interest in the acquirer previously held by the acquirer. And the last period is the goodwill recognized or gained from a bargain purchase. There's also additional guidance for particular for types of business combinations. So the acquirer and the acquiree may have had like the pre-existing relationships or other arrangement prior to the commencement of negotiations for the business combinations, or they may enter into arrangement during negotiations that are separate from the business combination. In either situation, the acquirer must identify any amounts that do not represent the consideration exchange between the acquirer and the acquiree or the former owners in the business combination. So specifically, it is like the amounts that are not part of the consideration for the acquiree. The acquirer recognizes only the consideration transferred for the acquiree, as well as the assets acquired and the liabilities assumed that are exchanged for the acquiree as part of the applying the acquisition method. Other separate transactions are recorded in accordance with the relevant accounting standards. So in business combination, we also have to consider the acquisition-related cost. So what is acquisition-related cost? Those are expenses incurred by the acquirer in connection with the business combination. So these costs include the finder's fees, the advisory, the legal, accounting, evaluation, and other professional or accounting fees. And it also includes the general administrative costs, including costs associated with internal acquisition departments and costs related to the registration, and also issuance of debt and also equity securities.